Hello, my name is Joe Mellum at Mellum & Associates in Houston, Texas. I'm in the insurance business. I've been in it for 50 years. I'm going to talk to you today about a problem that very few people know anything about because it happens in the dark. It's a problem of a broken life insurance policy. Now, what is a broken life insurance policy? That's a policy that has become underfunded. Now, the way an insurance policy becomes underfunded is a function of interest rates credited to that policy by the insurance company. If you go back to the 80s, insurance companies were crediting 11-12% interest to insurance policies. That's a pretty high interest rate. And when a rate is that high, that rate has nowhere to go but down, which it did. Now, during the 90s, interest rates stayed in the neighborhood of 8%. Coast to coast from all the insurance companies. They were pretty competitive. Then when 2001, 2002 came along, interest rates crashed, went down to the minimum interest rates the insurance companies can pay, typically 4%, sometimes 2% depending on the carrier. Now, the premium that's being paid on this policy is a function of the interest rate being credited to the policy. A computer is used to calculate a premium based on the interest rate that the insurance company is crediting to the equity. When that interest rate comes down, that premium needs to go up in order to compensate. And that rarely happens. 3/4 of all insurance, all permanent insurance, coast to coast, is underfunded. Let me add something to my comment about 75% of all insurance, permanent insurance, being underfunded coast to coast. I'll ask you a question. I don't think you'll know the answer, but what percentage of permanent insurance in the United States do you think turns into a death claim? The answer, 11%. That means 89% of all insurance companies purchased coast to coast never pays a death claim. The reason is people borrow money out of their policy, or they allow their policy to become underfunded by not compensating for lower interest rates by increasing the premium. Any insurance purchased before 2001 is almost certainly underfunded because of the decline in interest rates. Agents don't like to go back to their clients with bad news, telling them they have to compensate for lower interest by increasing the premium. So this happens in the dark. So it's a very good and important idea to review an insurance policy every couple of years in order to see that the premiums are properly funding that policy given the current interest rates. When interest rates decline, the insurance premium needs to be adjusted upward to compensate. The bad thing about an underfunded policy is the insured person doesn't know about it until they get into their early 70s. If it's underfunded, the policy runs out of cash. In their early 70s, they'll get a letter from some insurance company telling them their policy is going to lapse in 30 days. That's not good news for a 70-year-old. At that point in time, when they're in their 70s and the cost of insurance is higher, it actually goes up a little bit every year, but you never see it because you're paying a level premium. But the premium and the cost are not the same thing. Typically, when an insurance policy crashes and is corrected by increasing the premium is going to need to go up by about 400%. If you think you might have an underfunded policy, or suspect you do, or know somebody that might, such as a parent, as a service to you, I can check on that for you by having you sign a one-page service authorization, which allows me to collect information on your policy from the insurance company. I can make no change of any kind, but I can get details. One of the details is an in-force illustration, which will tell us exactly how long your policy will stay in force, given the current credited interest rate and the current premium you're paying. Chances are that policy is properly funded. If so, nothing needs to be done. From the in-force illustration, I'll be able to tell you exactly what premium needs to be paid or adjusted. When we find an underfunded policy, there's some pretty attractive remedies to fix that. One is to simply adjust the premium. But another one is using an IRS Section 1035 exchange program to swap that policy with a more modern policy, maybe with a different company. In that case, the equity from policy A is transferred to policy B, and policy B starts off with all the money that was in policy A. But the cost of insurance, or what's called the mortality cost, might be a lot lower. That can bring that premium back down. I checked on some life insurance coverage for a friend of mine not long ago who's 65 years old and who had a $500,000 Conseco policy. Well, Conseco went into receivership about 10 years ago. And as a result, they reduced the credited interest rate on his policy down to the minimum. And they increased the mortality cost on that policy up to the maximum. That caused his premium, which was $500 a month, to go to $1,700 a month. We had to do something about that. There was no way to improve it using Conseco. They were in trouble and they eventually were taken over by another company. So what I did for him was a Section 1035 exchange where I swapped that policy with a policy with a different company. In this case it was Voya. Now Voya has a more modern policy with a lower mortality cost. So we transferred the equity from one policy to the other, and the new policy was issued with the same death benefit, $500,000, and the same premium he'd been paying, $500 a month. If he had kept the Conseco policy, his premium would have gone to $1,700 a month. Now in some cases, a Section 1035 exchange can allow the premium to actually go down. And if there's a policy with a lot of cash value on it, a 1035 with a roll-in from the old policy can cause the premium to go to zero on a guaranteed policy. So reviewing your insurance coverage, keeping up to date on the coverage that you have, can cause your premium to go down or go to zero. So my question to you is, do you have a policy that was purchased before 2001 or 2008? On both occasions, interest rates went in the tank. So if you'd like to check your own insurance policy or somebody that you're related to or know, let me know and I'll send you a one-page service authorization that again allows me to check all the details on that policy, and I can report back to you within a week or so. Once I have a signed service authorization and have the details, then you can decide which options make the most sense for you, your family, your beneficiaries, their financial future. So if you're interested in looking into the details on your own policy, which may not have been looked at for a long time, contact me at joe@joemellum.com or call me at 281-679-5100, and we'll go over the details and discuss the possibilities of looking into that policy and fixing it if it's got a problem. Thank you.